So this afternoon we're going to talk about initial public offerings, have a look at some prospectuses. I suspect on the original timetable I didn't have topic 2 covering into today, but I'm pretty sure we will have caught up to where I want to be by the end of the day, just in case you're worried. Before the end of the day too, we might talk about when we might pop in a couple of webinars as well. So initial public offerings, we've already come across them a number of times. Sometimes we call it floating the company, and we use the term IPO quite regularly. So again, I'm going to race through these first couple of slides because you've seen them before. Basically, the regime, which is based on this idea of disclosure, essentially says if you're going to offer your securities for investment or to subscribers, then you need to make disclosure to investors unless an exemption applies. And Section 707 is the provision that sets out what kind of sales need disclosure. So I think in a somewhat clumsy way earlier this morning or in a previous video, for those of you listening online, I've just realised I haven't brought my microphones over, but I'm recording, it's all good. Sorry. I was talking about how the regime deals with both issues and sales. So as a general rule, selling a share doesn't need disclosure. However, certain types of sales will, particularly if the reason for the sale of shares is to avoid the disclosure requirements that would arise if there was an issue of securities. So sales that amount to an indirect issue. Let me give you an example of that. If a founder were to sell shares and then use the money that was the proceeds of that share sale to invest, to lend to the company, purely to avoid the cost of putting together a prospectus or a disclosure document, then Section 707 would say, too bad, so sad, you're going to need to issue a disclosure document anyway. But the provision itself lists out the circumstances. Again, I showed you 705 before, basically lists out the different types. What I want to point out this time around in particular is that the provisions, it shows you, once you know what kind of disclosure document that you are looking at, so say we're looking at a prospectus, it'll tell me these are the sections that tell me what content a prospectus has. Short form prospectus content will be the same. As it turns out, all this might well be the same anyway. Okay, so basically gives you a little bit of a mud map for getting through the provisions. And again, we saw exactly this slide earlier, which is talking about the exceptions, but I have assumed that we've got our company out of the stage, we've taken advantage of these exceptions, we have got some investors, some of them might be professional, sophisticated investors, including a fund that is particularly interested in investing in this way. Some might be our friends and our family, some might be just small angel investors. We've got a range of investors, we've used the exceptions, and we're moving on to the stage where we think it's time to go to an IPO. So IPO is that catch-all phrase that effectively pulls together a number of different processes. It is possible to make offers to the public using disclosure, complying with the law, and not actually listing on a stock exchange. But at the end of the day, that's pretty rare. So I want to talk about the transactions that you're likely or possibly will come across in your lifetime. And so when we're talking about an IPO here, we're going to talk about companies that not only make the offer to strangers to invest in themselves, but seek admission to the official list of the ASX, and that their shares are quoted on ASX. Now, as we mentioned yesterday, there are a couple of other exchanges that are available internationally and in Australia. The ASX is absolutely not your only choice, but it is the most relevant capital market to what it is that we're talking about. So I'm going to talk about the ASX. I haven't even recently looked at the Newcastle rule or any of the alternative board rules recently, but the principles apply in a very similar way. So we can work from there. So basically all of these things happen in order to move from private company into this listed company space. The company itself needs to be admitted to the ASX. In other words, the ASX has to agree that it is a company that is suitable for listing. Its shares, ordinary share capital usually, will then be quoted on the stock exchange, which is effectively just a trading platform. The company will need to comply with the ASX listing rules. And the listing rules, I mentioned them briefly in passing before, but that's effectively a contract, ultimately, between members of the official list and the ASX itself. And the real focus is what happens, how continuous disclosure works, but also when there are significant transaction, what happens. So we're going to, for all of the transactions we're going to look at going forward, we'll keep referring back to the ASX listing rules. Actually, listing rules, let me just pop out of there for a second. ASX, just want you to see ASX listing rules, they are in a database in our resources, they're online, so in the library. But often the quickest way to get to them is actually just via the ASX listing rules. Or the ASX website. In a very peculiar thing, I think, just as an ode to somebody making money along the way, you can't actually print listing rules when you find them on the stock exchange website, which is actually relatively useful, I think. It stops me from printing things. You can pay for a subscription that allows you to print, but otherwise the rules are available for all to see but not to print out. I just want you to have a quick look at the table of contents so you get a sense. And we'll have a look at this as we go. So basically, each group of rules is bundled into chapters. So chapter 1 is what we're dealing with to start off with, which are the rules that relate to how a company gets admitted to the list. And then chapter 2, the rules for how its shares get quoted. So they're actually two separate things, admission and quotation. So a company can be technically admitted to the list, but its shares may not yet be quoted, or they may in fact be suspended from quotation for some reason. Again, right up at the beginning, really important is this continuous disclosure regime, which we discussed very quickly yesterday. I'm just going to pop into that so you can see a couple of things, partly so you can see how the rules, what they look like. Again, they start with this quite useful kind of guide because we've got the rules and then there's a whole lot of forms that follow through as appendices to the rules. Each one starts with an explanatory note. So basically we talked about this rule yesterday. I'm just going to see if I can make that bigger so my old eyes can see it. So basically this reflects the continuous disclosure regime that is in the Corps Act. It's a little bit different from the way legislation works in that they've got this kind of convention here that if a term is defined in the rules, it will have this little plus sign sitting next to it, which points out that it's a defined term. So the term aware and information are clearly defined here, or clearly they are defined in this document. Sorry, that made it sound like they were defined in this term, which clearly they're not. Once an entity, so entity here means an entity, a body corporate. Why do you think that they don't use body corporate or company?
Because not all corporations are companies.
Not all corporations are companies, and not all bodies that are listed on the stock exchange or that have to comply with this rule are companies. They might be, for example, trusts, so a listed trust, so an entity. So again, it's like really sort of basic stuff, but it's really good to have a look at these rules and get yourself familiar with them if you're thinking about particularly, well, in order to be an M&A lawyer is why I'm telling you to do it, but actually, just as a little spoiler alert, they will help you do these assignment tasks as well. So once an entity is or becomes aware of information concerning it, and I tried to paraphrase this the other day, that a reasonable person would expect to have a material effect on the price or value of the shares that are listed, the securities that are listed, the entity must immediately tell ASX that information. So it's interesting here. We have this reasonable person test. It is so it's very much an objective test that we use. And then, like any rule, all of the rules here, it will tell you how long it's been in place, what its origin was. The old listing rules had all sorts of weird numbering. I'm actually, since the new rules have been in, which is I think at least the year 2000, possibly a little bit earlier. I'm not quite sure why we need the old chapters anymore. Even I've kind of moved on and remembered. It also gives you a note that tells you what the relevant provisions of the either common law or more likely Corporations Act are. So we've got this big sort of note here, and in fact it gives you kind of like a shorthand explainer of how it applies. So they can be quite useful, and we're seeing more of that explanatory material come into the Corporations Act in these spaces as well. So, of course, as is the way in pretty much all of the law, there's a rule and then there are some exceptions to it. So the key ones is that one or more of the following 5 apply. You can't tell the stock exchange because it would be a breach of the law to do that. The information concerns an incomplete proposal or negotiation. The information comprises matters of supposition or is insufficiently definite to warrant disclosure. In other words, it would add to the confusion in the market. The information is generated for internal management purposes of the entity, or the information is a trade secret. So any one or more of those, and it is in fact confidential, and ASX has not formed the view that it's ceased to be confidential. And, the catch-all, a reasonable person wouldn't expect you to tell them. So it's these ands that can actually be the undoing of people. That you've got these reasons why you might not have to tell somebody, but you have the ands. Goes on to talk about the potential for a false market. So one of the reasons for the continuous disclosure regime is to make sure that people aren't trading on information that isn't publicly available. So how is this relevant to IPOs? The reason I want to point this out to you really early on in the process is because the standard that is required for disclosure when there is an initial entry onto the ASX, initial offering of securities, is higher than the Chapter 3 requirement. So you have a prospectus level requirement, and we'll go and have a look at what the law says there in a moment. Just to recap, just to make sure you've got an overview of what's here. Continuous disclosure merits a chapter of itself. Chapter 4, periodic disclosure, that talks about annual and half-yearly reports, the requirement to disclose things like changes in shareholding, etc. So there are a number of little bits of special rules for mining companies. So Chapter 5 deals with additional reporting, again, for oil and gas and mining on exploration activities in particular. Chapter 6 deals with securities. We'll come back to this as we think about issuing new securities, but it basically talks about the type of security that you can have on issue. So when I talk about chapters 1 and 2 as being key to understanding the admission and listing process, in order to be admitted and to list, the securities will need to comply with chapter 6, sorry. So chapter 6 starts off with an obligation that we have one class of ordinary securities. So now remember, in the process of building this lovely little robot company that we've been building, we've been issuing shares to people with all sorts of preemptive rights and convertible rights. So they've got shares that are not ordinary shares. So in the lead up to listing, one of the things that lawyers will do is work through the transactions that are necessary to convert those ordinary securities, those other classes of securities into ordinary securities. So that's just corporate action activity. So that usually will require a meeting of a class of security holders. Those of you who have done company law will remember that if you're going to try and change the rights that attach to a class of securities, you need to get the approval of the majority of shareholders holding that, or holders of that type of security. Again, there might be a contractual leap in there. I have seen, not often, but I have seen companies or individuals holding powers of attorney, giving them the right to vote in meetings to convert classes of securities pending the issue of a prospectus. So there are lots of different ways to get to that. You can list other classes of securities. For example, there are kinds of options that trade and kinds of preference shares that trade. But you'll see here, if you pop some time into chapter 6, that the rules themselves basically say what kind of rights need to attach to the securities if they're going to be listed securities. Why is that? Why does the stock exchange care what rights attach to securities if all it's doing is providing a market for people to trade those securities? The common understanding piece, I think, is what is important here. It's like, if I am thinking about buying shares in Westpac or shares in NAB, I'm going to spend $2,000 on shares. I want to spend it on a banking stock. I'm going to pick a bank. Now, I can understand that, if one company's share price is different from another, that doesn't mean that it's necessary the share is worth more or less. What the share is worth, or what proportion of the company I get, depends on how many shares are on issue, what the size of the bank is all sorts of other competing factors that might go into that. But I'm expecting to get a share that will have some rights attached to it. Rights to vote at the AGM, rights to receive an annual general report, rights to participate in rights issues. And so if all of those fundamental rights are the same, then really all an investor is comparing investment opportunities, not actually what contract are they getting. And also, ASX is providing a market in which everyone from mums and dads through to international financial institutions are investing. If we have all sorts of different types of rights, then we end up with inefficiencies in the market as a consequence of fights over what those rights and what those terms might actually mean. When we're listed, and we'll go and look at some of these later in the next couple of weeks when we meet again, Chapters deal with things like significant transactions, so that's buying or selling significant assets, changing the way that your business works. These are clearly absolutely important to merger and acquisition transactions. If our listed company is going to go and buy an asset, particularly if it's an asset that fundamentally changes the way that its business works, then people who have invested in our robot company might not want to invest in our cup of tea company, and as a consequence, there are some built-in minority protections in the rights by our agreement to comply with these rules. The rules also look at changes in our capital and new issues. So new issues, just because we've got to listing doesn't mean that we might not go out to the public and ask for more money again in the future. Sadly, with my company, we've done that a number of times. But again, every time that we issue new shares, we are effectively changing the proportions of the pie. And if there are no controls on that, we risk a fraud on the minority, or shareholders who've come in buying one thing actually not getting that thing. So there are a set of rules that deal with that. And we'll look at that in the context of paying for an asset by issuing new shares. We talked a bit about a reverse takeover the other day. It doesn't have to be a takeover. Companies will buy things with shares all the time, so we can look at how that works. There's also a chapter about transfers and registration, which is not surprising because people who invest in companies on a stock exchange, they do that by trading shares. They buy shares that have been quoted from people who are bidding for shares in that company. They may never know who those people are, and they're basically selling them. They sell them through a mechanism that works the same way for every transaction. So it's like a standard form contract that just gets executed over and over. Other things that the rules address probably won't surprise you, things like the way that shareholder meetings for public companies or listed public companies need to be managed, requirements in relation to documentation, both documentation that goes to the ASX and through the ASX to ASIC, but also to shareholders. So they can be quite mundane, down to the order that things are put in and the kind of fonts that you use, right through to very broad statements that put the onus on directors to decide what needs to be included, through to forms that need to be filled in and filed over and over again. The ASX is a business and it charges fees for the luxury of trading on its platform. It charges companies a percentage of their share capital every year for the luxury of having their shares traded and complying with the rules. And through a different set of rules, it also charges brokers or others who have access to the facilities who can actually execute trades. So if you can't just front up to the ASX and say, I want to buy a share. You need to go through a licensed broker. A licensed broker means somebody who both has an Australian Financial Services licence that allows them to trade shares on the stock exchange for somebody, but also has a contract with the ASX that says how they are going to move money around effectively and how they're going to comply with settlement terms. It also has its very own last chapter, even follows the definitions and interpretation which was added when the ASX itself was listed, so it has its own special set of rules. So worth having a look so you've got a sense of how, because it is once you're listed, this is a really important contract, an important set of rules that you need to comply with. And I think it's really interesting that they've clearly not been written for lawyers. They've been written for company secretaries, for executives and for directors, for how they're going to manage being on the list. So let's just pop back to admission. Chapters 1 and Chapter 2 are pretty short, really, and I'm not going to go through them in detail. I just want to show you quickly what they look like. Nice little explanatory note at the beginning, explains this point of entities that we just spoke about, talks about the different kinds of listing that are available, and it sets out now what requirements for listing are. So, in theory at least, any company that is seeking listing would be well advised to go and look here and say, am I actually going to meet the conditions? So the very first one, its structure and operations are appropriate for a listed entity. So what do we think that means?
Number of shareholders, the revenue.
Number of shareholders. We'll talk about that. It has specific rule about number of shareholders, which we'll get to in a minute. Revenue maybe.
The assets that they have.
Assets. We've got specific rules in relation to that. This is the one we never spend very much time on. The structure goes to, does it have the right kind of security? So that's the Chapter 6 question, right? So is it actually an incorporated entity? So if we were a partnership and we wanted to list, so many of you will have followed the story of some of the law firms that listed. So one of the things that needed to happen in order for law firms to list on a stock exchange, there were more than this, included changes to the rules that meant people that didn't hold full practicing certificates were allowed to invest in law firms. But one of them was we needed to be allowed to practice as an incorporated entity as opposed to a partnership. Because a partnership, for example, is not an entity. So it needs to be a structure. So a company can be incorporated in some jurisdiction without necessarily having a register of shareholders. So you might have heard of the British Virgin Islands, BVI companies, or Cayman Island companies. There are a number of jurisdictions that will allow companies to issue what are called bearer shares. In other words, there's no list anywhere that says these are the shareholders of this company. You are a shareholder if you have the share in your hand. A share is more akin to, most of you are too young and will not remember cheque accounts, but a cheque, unless it was marked not negotiable, and even then it was pretty easy to change, a cheque is a negotiable instrument. A bearer share is a negotiable instrument. It is something that entitles you to the stated interest in the company, but you identify your ownership by showing that you've got the piece of paper. Again, I think I recommended Laundromat on Netflix to you yesterday. There's quite a nice scene that shows how important bearer shares can be to an environment. So again, that's the kind of thing that the ASX is looking at. This is unashamedly and purposefully vague. In particular, because it effectively, these words operations in particular, it gives the ASX really broad discretion to say, no, we do not think you are the right kind of company. Now, they don't like exercising it because it does get them into trouble with ASIC from time to time, and it does, the economists amongst you will say, markets work better when they're left to themselves, and the market should decide what is an appropriate business to invest in and what is not. But at the end of the day, it gives the ASX that opportunity. The only time I've ever seen ASX use Condition 1 in relation to operations in any practice I was involved in was probably one of the most unfortunate and stressful deals I've ever had any involvement with. But a client of the firm that I worked for ran some licensed brothels, and they wanted to list their very, very profitable brothel business on the ASX to realise some value. And the ASX said no. Notwithstanding that you are not breaching the law, your business is not suitable for, your operations are not suitable for the ASX.
Tobacco companies are about it.
Yes.
So that's hypocritical.
It's very hypocritical, and that's why, and in fact what they ended up doing, this is a very profitable company, and it owned a range of properties. So it owned the businesses that the brothels were conducted in. Ultimately, what it did is it created a property investment company that owned the properties, each of which was subject to very long-term, like 20-year leases or something, and that company could be listed. But look, again, and this is what economists will all say, this is, it's a matter for the market. If people do not want to invest in tobacco, weapons, brothels, pharmaceuticals, financial services, insurance, then they have mechanisms for doing that.
But a lot of people don't realise through their superannuation funds are invested.
Well, that's the next point that I really wanted to make. Oh, no. I love it when you make my points for me. It's absolutely perfect. The counter to that argument is that's theoretically possible, but the reality is structures are so complex, and when people have most superannuation is in turn invested in funds. Funds then manage a range of different investments. You only know what funds are, what investments a fund has at their reporting dates. So line in the sand dates, let's say 31 December, 30 June, a fund will say our top 20 biggest assets are blah, blah, blah. But they might have bought them the day before and sold them the day after and held nuclear weapon and asylum centres and nothing else in between, and you would never know. I had actually a very great fortune to teach ethics in the MBA course for a little while. I had this fabulous student who was from Norway who wrote a paper that I just wish I could just give to everybody. It was so interesting. But Norway, as many of you will know, is a very wealthy country in large part because of the way that it has dealt with the investments that, or the money that's come out of the North Shelf oil and gas. So in short, I think Britain got about half of that money and spent it pretty much immediately and has nothing left. And Norway has basically invested and reinvested and has a massive pension system. It has all of these things. But also, the Scandinavians, being better than everybody at everything, have, set in place these fabulous rules. I'm speaking as the lefty you've probably worked out that I am, saying, that they're not going to invest, for example, in nuclear weapons, they're not going to invest in chemical weapons, they're not going to invest in this and that. But actually you do not have to dig very deep to see that there is compliance with these rules at one level, but then they will invest, there's lots of investments in infrastructure that supplies to the weapons industry, for example. So if a very wealthy Scandinavian country, let's face it, we can all imagine, we've probably got Nobel Prize winning Olympians basically running this fund. If they have difficulties drilling down in order to comply and work out what the rules are, what chance does my dad have of working out where his superannuation is? There are a number of funds, ethical investment funds in particular, that look to that when your specific issue is I don't want to invest in tobacco, I don't want to invest in brothels or whatever that happens to be. But again, that means that you are dealing with a fund. So there are more and more Sharia funds that are coming up too, which will look at investing within a particular set of Islamic rules about investment, avoid or not taking interest, for example. But that also requires, there's a huge amount of complexity in setting up and maintaining a Sharia fund. And the Sharia funds, too, as a consequence, the costs are higher than they otherwise would be. So sometimes we just end up with the ASX saying, we're going to give our, we're just going to make a call. But I've got to say, they didn't do it I haven't seen it very often. I've had friends who can't believe that I was actually involved in a transaction where they said no, but they do happen.
I think it was last year, there was a Bitcoin company which wanted to actually get listed on ASX.
Yeah, there's a cryptocurrency. They've changed the rule on a couple of cryptocurrencies, and there was I can't remember what it's called, but a version of Spotify that did
Yeah,
actually
exactly,
get
yeah.
up, and I can't remember, but it's basically a music sharing app. But the issues they had with that were more around the management and overstating. Yeah, Quivera.
That was a massive failure.
Yeah. So again, the market learns. The entity needs to have a constitution which is consistent with the listing rules. Okay, one of the ways that we used to deal with that a long time ago is early stage we would be writing constitutions that match the listing rules. Subsequently, we now have Appendix 15A, and 15A basically provides this nice, neat little rule that you stick into whatever your constitution is that you're happy with, and it says at the end, if we happen to be listed and any of the rules above are inconsistent with the listing rules, then the listing rules apply. So that's pretty so that's basically been in there since this new range of the listing rules in about 96. Actually, I'm going to make that a little bit bigger for my eyesight. I hope you don't mind. Condition 3, you need to issue a prospectus. Okay, so we already know we need to issue a prospectus if we're going to make an offer to the public. So this is just, it's a different obligation, but it's the same prospectus, right? We don't need to issue two prospectuses, two prospecti. I have no idea what the plural of prospectus is. Collective noun is a confusion of prospectuses, no doubt. It's still the same disclosure document, prospectus, or you would use a PDS, product disclosure statement in relation to a listed trust, or a managed investment scheme, I should say, and that prospectus needs to have been lodged with ASIC. So basically the listing rules here are dovetailing in with the Corporations Act rules that we'll look at as we move forward. We do have this information memorandum that require option, but given the protections that directors get if they issue a prospectus in relation to what we'll call the due diligence defences, an information memorandum is relatively rare. And when that actually usually happens is when a company is listed in another place and wants to be also listed in Australia, rather than have to go through the whole thing again, it can take its compliant relevant information, because a prospectus is a document for issuing shares. If your shares are already on issue, the information memorandum is basically giving that same information to the market. Condition 4 for foreign companies, you need to get yourself registered and have what is called an ARBN, an Australian Registered Body Number, with ASIC. So that will require you to have a registered office here and to have a local agent here, somebody to receive correspondence, etc. I'm not going to worry about trusts because we're not really going to talk about them so much, but it's worthwhile seeing that there are some rules for a trust. You need to, and this will bring us back to Chapter 2 in a minute, you actually need to make an application and be granted permission for your securities to be quoted. So the company gets admitted, that's one part of the approval process. The securities need to be quoted as well. All right, this is relatively new rule. The entity needs to have a free float at the time of its admission of not less than 20%. In other words, 20% of the shares that are being quoted need to be held by people who are not insiders to the company. So not founders, not the original promoters, not the underwriter, new people, usually. Now, why would we have that? Can anybody think of a reason to add a rule like this? Liquidity, exactly. If, all of us decide our robot company has done really well and we want to list it, but all of us just want to see the share price grow, none of us actually want to sell, then unless we've got shareholders who are prepared to buy and sell, we end up with a company that's not really trading, not really doing anything. So now there's not much that the ASX can do about that when a company is already in existence. So you will see, and this we were talking yesterday about some of the small Western Australian mining companies that become technology companies and then go back and become mining companies again. There's actually, there's not much that they can do about those companies when they don't have, when they've already got investors in place. But prior to listing, they can have this rule. The other thing that they do to make this happen is they look at the number of shareholders. So you need to have at least 300 non-affiliated shareholders who have at least $2,000 worth of shares at the listing price. And if you do this artificially, in other words, we go out and I sell you shares and I sell some to Michael, and then I say to Michael, oh, you want that $10,000, could you hold some of that yourself, and your partner can hold some and your superannuation company can hold some more. Yeah, so we're going to trace and look at those. So you need to show that you have the word that we use in the industry. I don't know why they don't use in the word, because they're not shy about using jargon in the rules, is spread. You need to have a sufficient spread of shareholders. Oh, now I say that and I've highlighted the word spread, so yeah. So we're going to look then at the next two rules. Basically, condition 9 is one or other of the profit test or the asset test. So really, either this is the gold standard. Company that is profitable, has shown profits for a period of time. We'll look at the rules so I can remember the numbers exactly. Will meet that requirement. The assets test is effectively saying for companies that aren't profitable that you have enough cash in the bank that your assets are sufficient for you to meet the objectives and the commitments that you have. So Domicon, when it listed, went in under the assets test. So it wasn't profitable at that time. It was seeking money to take the beta version of the business to market. Okay, you might have noticed the word escrow above, and then we've got this word here, so restricted securities here. So if the entity issues restricted securities before it's admitted to the official list, it needs to do the things that are said in Chapter 9 and give completed restriction agreements to ASX. So that is not at all obvious what that means just by looking at it. So a restricted security is a security that Chapter 9 of the Listing Rules says is the kind of security that you shouldn't trade. So it might be a type of security that has that it has rules associated with it that are inconsistent with the listing rules, although that's pretty limited. What it is more likely to be is shares that were issued to founders for little or no money. So this is where you might remember that I mentioned before that as we're funding our business, one of the things that can happen quite often, particularly if we're not careful with language, is that founders will actually want to sell their own shares in order to basically be able to pay their own mortgage, pay their own bills. And it's not an unrealistic thing to ask for. They may not be earning any money at all at the time that they're doing it. So they sell some shares to people who are interested in getting into the company. Other shareholders are pretty happy about that because they're not being diluted, and that our CEO is less likely to be saying, guys, I need you to be able to pay me some money at this stage. It all sounds great, except for if our founding shareholder didn't actually pay cash for those shares, they just put in their intellectual property and their time, then they are likely to be restricted securities. And as a rough rule of thumb, say your issue price for shares at the time you float is $1, and a founder has 1,000 shares. It's going to be a lot more than that. 1,000 shares that they have paid in total $1 for. Then 9,999 of those shares are likely to be classified as restricted securities. And that means that they will be subject to restriction agreements that do exactly that. They restrict the shareholder from being able to sell those shares for a period of time up to 2 years. The more involved in the operations of the company that shareholder is, the longer the escrow period is. If the original person who bought the shares paid 50% of the price that they're being issued for, the number of shares will be halved. So they'll be able to sell some and not others. The idea is to really stop people just dumping their stock on the market and running away and leaving new investors who've put money in for dead. Where it gets a little bit tricky is if I bought shares from a founder, the rule traces the security, not the holder. So if I buy a restricted security, or actually, given it's me founding the company, if I sell a restricted security to Mohammed here, he might pay me full price for it. But if the original paid up value of that share was, 1 cent as opposed to $1, then 99 out of every 100 shares that he has bought are going to be restricted securities. Shall we say that makes for some very unpleasant and often unexpected conversations in the lead up to a float. And that sometimes can be negotiated in not so much with the ASX, but at the end of the day, they need to see the number of shares. And so as long as we get the right number of shares and the right people escrowed. So again, the old language, the industry language is escrow. When do the shares come out of escrow? But the ASX listing rule language is restricted securities. And it does that for a number of reasons. Partly, I actually think restriction makes more sense. If you are an outsider to the market, the word escrow doesn't really mean anything to you, but it can make sense. There's restrictions placed on the buying and selling of these types of shares. But I think also escrow is a term that is used in a whole lot of quasi-legal ways in a whole lot of different places. So Americans in particular will often confuse or interchange the word escrow and deposit in relation to buying something, for example. So please interrupt and comment or question as I go, because I am literally going to walk through these rules and give you an overview.
But do you know the Islamic finance?
Well, let's talk about that offline because it's not relevant, but I know way more about Sharia law than any middle-aged white woman should need to, let me tell you. It's actually fascinating. It's really interesting, and I think, anyway. So condition 11, if in the 2 years prior to putting your application in with the ASX, you acquired a particular type of asset from a related party or a promoter of the company, then the consideration will be treated as restricted securities. So your shares will be treated as restricted securities unless it was an actual reimbursement in cash of money that you spent, or there is an actual out. So again, that's dovetailing in with the explanation I hope I've already given you relatively. Well, WeWork was trying to list in the US, but actually I might add WeWork in as an example next time around too. That is just, it is, it is just, how well do we know each other? Can I say clusterfuck without actually being complained about? If you say no, if you say yes, I won't say it.
I was at a valuation seminar, and it's a very prominent valuation expert there, and this was before it blew up. And he said, I've read the prospectus back to front, and I still don't understand how much money they make, how they do it, and where it's all.
Well, there's that. Actually understanding how much money, actually articulating how you do or you plan to make money is not as easy as it looks, okay? There is that. But when you are actually spending money that you don't have in ridiculous ways, then that's just taking the piss. They're insane.
You never buy an IPO. You just wait for it to have a little bit of history and then decide,
Often the IPOs are
Yeah. Well, that has been in recent time, but again, and that's part of the pricing. We'll talk about pricing strategy. Again, I'm being very open with what I think the issues with Domicom have been. I have no doubt we were significantly overvalued at IPO. Significantly overvalued. There was a strategy in place. Brexit killed that, but we should have changed the pricing at that time, and I have absolutely no doubt about that. And the thing is, when it goes down, so when we did premium, we did a lot of work to make sure that there was an appetite in the market, that the price that we were offering securities at was at a good 10% discount to what we thought the appetite actually was. And it turned out to be actually a little bit, at the time, a little bit more than 10% overall. But so we were seeing that lift. But I think, it was just a different time by the time we got to Domicom as well. And again, these are things on the whole that the lawyers don't need to think about, that money issue. But at the end of the day, one of the things that the directors are doing and lawyers will be advising on is this prospectus, is the disclosure providing potential investors, both the ones who are coming into this, effectively the ones who are coming into the issue now, and people who might buy shares later on a stock exchange, is it providing them with an accurate understanding of what this business and its prospects are, and what the rights are attaching to the securities, what the risks are. And if you're talking about what the value or prospects are, and you're going out at a value that is significantly higher than what the actual value is, one of the things that the lawyers are really asking directors to do is to actually look in the eye and say, okay, does this actually represent true value, up or down? And, it's a very hard thing to do. What do you need to do? Okay, this more is about getting some documents in. You need to be approved as an issuer of quoted securities, or you need to be established in a jurisdiction that will allow that to happen. So we're getting more into the logistics side at the moment. At the time that you list, you actually have to provide quite a detailed lot of information that goes to the market when your application is approved. And that includes information about corporate governance and your approach to corporate governance. So it includes right from the very beginning, do you have independent directors? What are your corporate governance policies? I'm going to come back to that shortly. Okay, this is at the bigger end of the market. So does everybody or anybody have a sense of what the S&P All Ordinaries Index is? Yeah, nodding. Okay, so basically you are a larger company by the time you're getting in there. And so ultimately, if you are in this list, I actually have no sense. Oh, yeah, I'm happily make it bigger, sorry. How's that? There we go. Sorry about that. So again, you would know by the size of the company whether or not you would have an audit committee. I would suggest it's pretty rare these days for a company to apply for listing without its corporate governance policies, including that it'll have an audit committee. So what an audit committee is, it is a committee of independent directors, so a committee of the board that is tasked with basically interrogating the auditor and to ensure that the auditor has received the information that it reasonably needs from management. They do usually the first run of the financial reports, and so they really focus on the numbers for the board. Remuneration Committee. Similarly, Remuneration Committee's job, it's often conflated with the succession committee for the board, working out who the directors are and actually reviewing what directors' remuneration should be and whether it's market, and also looking at particularly the C-suite of directors to ensure that people are not being overpaid. You will know in recent years that at AGMs, shareholders are asked to vote on whether they effectively like the remuneration report, which is part of the annual general report each time, and there's a 2 strikes rule. So if a company votes twice against the remuneration report, then the directors effectively need to resign, and you need to, it's not as quick as that. They can vote twice. If there's 2 no votes, then you have a vote as to whether or not there should be a meeting to spill the board and to re-elect directors. So this has been all about really bringing a concept of or a preconception or a conception that there are overpaid CEOs in this world, and to basically provide some constraints on executive pay.
I don't think we've had a single case because where it's gone to the board spill and there's
a few that have gone to board spill resolution, but I don't think that there's been anywhere there where certainly none where all of the directors have gone. Okay, so a little bit more in logistics. Interestingly here, good fame and character, relatively new rule. And again, that's kind of interesting as well, because there pretty much any person over the age of 18 and under the age of 72 from memory can be a director of a company. In fact, you can be older than 72. You just have to stand for election every year after that point, just in case. I think it should be 54, given how addled my brain has been today, but let's not comment too much on that. But it's unlike being a solicitor, there's no obligation to demonstrate that you are of good fame and character under the general corporations law or under company law models. If you do something that means that ASIC determines that you are no longer a suitable person to be a director, you may be barred from being a director for a period of time. And certainly that would go to whether you were a person of good fame or character for this rule as well. So let's get down to the rules. Profit test. So remember, you can one or other of these rules. You need to be a going concern. So this rule is satisfied if the entity is a successor of a going concern. In other words, there can be a restructure and then a listing, or even a demerger and then a listing. So it might be that the new corporation is created at this time that it is listed for some reason, particularly if it's a spin out from a larger organisation. As long as it's coming out of a going concern, we don't have any problem there. Going concern is basically used in the accounting sense and the common law sense of the word. It can pay its bills as and when they fall due. The entity's main business activity at the date it is admitted is the same as it was for the last 3 full financial years. So in other words, it's a going concern, it's profitable, and it's profitable doing the same thing today as it was doing 3 years ago. This is sometimes the 3-year test, or inability to meet the 3-year test, is for fast-growing companies, may be the reason that they go in under the assets test, even though they're already profitable. You need to be able to provide the following: audited accounts. This is often what slows down the preparation of the prospectus no end, is because companies that are growing may not have been audited until the decision was made that we're going to end up listing. So in fact, pro forma accounts need to be prepared and the auditors need to go back over time. So that can be actually a very expensive and really frustrating part, particularly too if the company's grown out of a number of mergers or acquisitions of different businesses. Timing gets affected here. So if you apply for so basically you've got to look at the timing. So your audited accounts can't be too old at the time you apply. So that actually often adds to the urgency. Sigrid and I were talking during the break a little bit, and I was saying one of the reasons that I kind of got out of doing this all the time, like her partner, is that you just don't get any sleep. It's just like everything is always wanted yesterday, everything is urgent, and often it's just because it's expensive. Just doing the transactions is expensive, and people want to know, and there are times, the longer it takes, the more likely news gets out or things can change. You just want to settle something and move it on. There are very few rules in the law that actually require things to happen within a specific timetable, but most of them are to do with how old the financial information is, just making sure financial information is new. So if you more than 6 months and 75 days after the end of a financial year, you need to provide half-year accounts as well. And you need to provide a pro forma statement of your financial position. So in other words, you have to create accounts that show what your post-money balance sheet is going to look like. You've got basically a pre-money and a post-money account, so a pro forma is what's included. So the actual profit test, for at least the last 3 full financial years, you must have made at least $1 million in profit. And in the last 12 months, up to 2 months before, it had to be more than 500,000. So from continuing operations. And directors need to include a statement specifically to the ASX confirming that they've made inquiries and nothing has come to the attention that would suggest that it's not continuing to make that profit. Assets, whole lot easier, and goes basically to the balance sheet as opposed to what's happening in the profit and loss. Net tangible assets of at least 4 million after taking out fundraising costs, or a market cap of at least 15 million. So market cap basically means the number of shares on issue multiplied by the price of those shares. So if you have 15 million shares at $1 each, you will just scrape in under that rule.
This is only for the listed company, public company.
Yeah, well, this is to get admission to the official list. So we're looking at the rules for admission to the official list. So in order to get in, so a public company might in fact have 1 shareholder, 3 directors and $100 in its bank account and have done nothing for 10 years, other than borrowed money perhaps to repay its, to pay its Asx subscription. Subscription is the wrong word. So as a public company, you don't have to do anything. But if you want to become a member of the official list, these are the criteria that you need to meet. So
it's not a mandatory to all the public company is a listed company?
No.
Okay.
No. All listed companies are public companies, or one. No, that's not even true. Most listed companies, as opposed to entities, most listed companies are public companies, but the vast majority of public companies are not listed.
And even greater vast majority of companies are private companies, which
Yeah.
cannot be listed.
No, they cannot be listed. So you need to be a public company in order to be listed, or an appropriate entity.
How do you determine market capitalisation? What's the definition? Because who's making that market? Is it the last post-money valuation of their last funding round, or
no? For market cap at that point, it would be based on most recent share offer price, which in most cases on IPO would be the share offer under the prospectus.
Which is minimum.
So. And again, there's a minimum 20-cent price, which we'll look at that in relation to quotation, but and that's often we need to do a consolidation. So again, I might look like I'm spending quite a lot of time here, but the thing is, I think often what happens commercially, one of the things that I see that happens commercially is everybody's focused on the prospectus, right? You all know in order to get listed, we need to have a prospectus. But actually, we don't unpick the reasons that we need to have the particular kinds of things in a prospectus that we need to have, and also why it is that we need to make these changes to structure and otherwise. So we might have a perfectly lovely company that's been floating along. It might be really profitable. It's existed for the last 2 years now. It made $1 million in its first year and $2 million in its second year, but I am not going to be able to get it in under the profits test. I can spend another year and hopefully make $3 million next year and I will be fine as long as I've got my audited accounts, or I can go in under the asset test, or I can make an application under the assets test, which will require me to do some different reporting. But again, if we understand the reasons why we're coming in there, I think we have a better understanding.
What about if they become a listed company, but after becoming a listed company, if they fail to holding their profit?
So can we come back to that? Because I think what I really want to do is get us through the process for listing first. Once we're listed, then we'll look at the things that we need to do once we're listed. Otherwise, we'll just all get muddled. Is that all right? So I know I do keep going backwards and forwards a little bit, so it's unfair of me to stop you. But there. So again, basically, we keep going through the rules. You'll see less than half of the entity's total tangible assets must be cash or in a form readily convertible cash, or the assets that it have we basically need to have a plan set out in the prospectus that tells us what we're going to do, what the commitments are for spending that cash. Effectively, this rule is to stop the creation of what are called cash box companies. In other words, companies who aren't licensed investment entities, who their job is not to just go around and make investments, just basically taking money from strangers and then sitting on it, waiting to do whatever they think is the best thing to do with it. So if you're going to raise money, you have to have commitments for what it is that you're going to do with that. Working capital rules, etc. Sorry, I don't want to go on for too long. Yeah, we basically repeat them. I won't work through the way that it works. What I want to do is give you now a look at what this looks like. So again, one of the tasks I think from memory, because it's in my memory that we're going to do it now, is it's worth having a look on the ASX website. I've just gone to its upcoming floats page. Now you can see that we've got some that are listed here that they were going to float at dates that are in the past. So the initial date that companies expect to get over the line sometimes gets passed, particularly if they haven't raised all of the money yet. So they're just listed here in alphabetical order. Yes, well, actually, I thought we might look at one of the hemp companies because I thought that kind of amused me. So that's this 13 Seeds company here. Happens to be, I didn't know what it was until I had a look over lunchtime. So, and we see, so this page doesn't tell us very much other than the name of the company, the code that it's expecting to use. So basically, all listed entities have a 3-digit code, and you need to know what that code is in order to be able to trade in their securities. And so at this stage, it's just a proposed code. So ASX has agreed to the code and a proposed listing date. So we can flip through all the ASX is going to tell us is what its website is, its telephone number. I don't know why anybody still has facts there. What it's going to do. This is a hemp food and nutraceutical company. It's actually, well, this is where I possibly need to put a warning over my recording that says I am not providing anybody with any financial advice. I have looked at this company for the first time this morning, but what I just want to do is show you this is, regardless of whether you are a huge, we could look at the Coles prospectus, a huge offer in the last year. ASX, it would have looked exactly the same. Doesn't matter if you're a tiny little hemp seed company or your household name fast consumer goods company, you get treated basically the same way. So if we go to the website, it looks here, you can have a look at the prospectus, but this is also, again, part of the compliance requirement. Every company will do this. They will have lists to links here to all of the documents for corporate governance, risk management, or their trading, all sorts of different things here. They are disclosing like there's no disclosure, right? So if you want to know about what this company does or says it's going to do from a governance point of view, which are all of these things, this is set out here. Now, because I wanted to have a look at the prospectus to see if it was a good example, so I've already done this. I'm just hoping it'll do it again because this is quite a standard way of doing this. First thing that's going to happen is it's going to ask me where I live. How about I tell it a lie? I don't live in Afghanistan. It's going to immediately tell me that, sorry, you can't buy shares in my hemp seed company because you live somewhere else. Now, again, this is just as much as anything about compliance. They're not actually really doing anything to see whether I am an Australian citizen or not. Look what happens when I go back and adjust it. Immediately I get a form that's being filled out. So they're not really doing anything to verify where I'm from as far as we can see, but that doesn't mean anything. Now, one of the things that I find quite interesting, but I think is kind of important for us to notice here. Let me see if I can just make that a little bit bigger so that some of us can see. Even though we've got the whole of the list, I'm specifically asked to say that I'm not a US person and that I won't make the document available to somebody in the US. We had this whole list of other countries that it's possible for me to say that I'm from, but I'm going to specifically say that I'm not from the US, and that's largely because of the long arm of the SEC and in particular the US tax authorities. So where you only have to have a little bit to do with them and they will be trying to collect your taxes.
If you're a citizen in the US, it doesn't matter if you haven't lived there in 30 years, they'll still try to tax you.
Yeah, my daughter's partner is a citizen. He hasn't lived there since he was 28 years. He's scared to go back. And yeah, well, not just because of the taxes, but there was a significant issue a few years ago where so some of the largest law and accounting firms in the world are based in the US. So Baker & McKenzie in particular, a US law firm, but it has partners all over the world. If you earn income from a US business, you are a US taxpayer as far as the US was concerned. I am again conflating, but there were significant issues. And what was happening is it was just too hard. So at the time I was spending a lot of time in the UK, and we were finding with our funds, we would be just saying, if you might be a US taxpayer, we're not actually going to let you invest in this fund. And the reason for that is the amount of the cost for us of the reporting that would need to be done in order for them to either pay tax or not pay tax, as the case may be. But once you're actually earning revenue from a US source, then you have to declare everything worldwide. So this is compliance, and that's the reason for it. It's not at all uncommon. Actually, I'm not going to put it in there again because I'm really not interested in being chased by this particular company. And I think I've got... so, again, pretty standard. It'll give you a little summary of the offer before you even have to open the document. So this company, so it's a public offer. In other words, anybody can participate to apply for up to 30 million shares at 20 cents each to raise $6 million. So we're raising $6 million before the costs. So again, right from the very, so it's very legalistic type language, but it's basically complying with the rules, which we'll look at in some more detail. Again, we're going to cover our butt about the US. I don't see why it's necessary there, but it's not uncommon at all to do it. And then, and this always makes me laugh as well, the heading is always further information, you know, if you want to know more, and then it basically says go and ask somebody else. Go and ask your stockbroker, your accountant, somebody independent. Don't ask us. We're not going to tell you whether we're a good buy or not.
And if your accountant gives you good advice, that might be good trouble.
Your accountant most likely will be in trouble if they do not have a financial services license. So I've clearly went down. I just wanted to, so this is what the prospectus looks like. So they often have quite a fancy cover. One of the things that differentiates, so there'll be printed copies of this available as well, but companies are more and more just going to the PDF and the electronic versions. So it's just the cost of printing a prospectus is not really needed. I should have brought one up for you. Actually, I'll just do this really quickly. US. Oh, yeah, well, can't. Thank you. I just want you to have a look at a US prospectus, if it will let us have a look at it, of course. Come on. I'll just go straight to one of the first ones. So in the US, you'll see this is actually it's more like it's not really a prospectus at all. But again, no pictures, very rare that you would have anything that isn't a graph, very, not laid out in a particularly nice way. Actually, I'm going to say this one I've managed to randomly pick is not too bad with 2 columns. They're just straight information documents. American lawyers that I've worked with over the years find it amazing that we have pictures in our prospectuses. I find it very, very disconcerting in some ways. And there have been issues that have come out of pictures in prospectuses. I think it's a while ago, but there was a float probably about 10 or 15 years ago now, which was a property services company of some sort. It had offices based in, or buildings in Sydney, Melbourne, Brisbane, and as you would do, it showed pictures of Sydney, Melbourne and Brisbane landmarks, the Opera House, the bridge, the spire, and ASIC basically said people might be misled into thinking these are your properties, because there was no disclaimer or anything. So you end up, when you've got these prospectus, I'm assuming these may or may not be hemp seeds used by this particular operator. Again, those of you who've done company law will remember that there is an obligation to put your Australian company number on any public document. This is a public document. So it's prospectus. A couple of things that you will always see in a prospectus right up front. So this is the summary page. Again, it's repeating information that we saw earlier. So there's a main offer for shares. There's also a convertible note offer. And basically, we're disclosing here that we're going to offer some options to the lead manager or to people that it nominates. Interesting, it's using the word manager there. It suggests that this one may not be underwritten. Okay, let's have a look at what they look like. How many of you have looked at a prospectus before? Sorry, I can, roughly half. Okay, I'm going to go really fast, and I'm going to encourage those of you who haven't had a look before to go and have a look through. Look through a few of them, because you will see that they're actually really, really similar in the way that they're laid out. You think, well, how much time and effort can go into this? It's obviously a standard form document, but again, they're not. So again, this is a pretty standard kind of table of contents. What is the offer, or what are the offers in this case? It's going to tell us about the company. It's going to tell us about the industry. It's going to tell us about the risks that are involved, the people who are managing it. It'll give us the financial information. It's going to summarise the material contracts for us. It's going to provide some it's always called additional information, but there is basically it's the set of information that the legislation requires, and then we move from there. So again, let's flick through, see if there's anything interesting. In recent times, this corporate directory page used to always be right at the end, and I've seen them sort of move to the front. Again, I might be speaking, showing my age by that. This is important because this shows us who the advisors are. And when we get into the actual rules in relation to the prospectus itself, you'll see that all of the people who are named in a prospectus need to provide their consent to being named, and as a consequence they gather liability if the prospectus itself is misleading or deceptive, or is otherwise it's faulty. So some of this is just compliance, like you need to tell the punters where your business is. You're going to need to tell them where your share registry is. Computershare, actually, we were mentioning them this morning. So this is actually a Tasmanian company, but its share registry is going to be here in Victoria. Very standard, now this is not prescribed by any law, but it's very standard to open a prospectus with a letter from the chairman. So somebody who is usually an independent director who basically tells you why you should do this. It's rarely written by the chairman, it's usually written by the lead manager, and often the lawyers will negotiate it back because the first draft will effectively say how you're an absolute idiot if you don't invest in my company, and we work backwards from there. Key details. So again, we're seeing here it's giving us two options. So there's a minimum subscription. So they're doing a minimum raising. So they're only going to close this offer if they get 5 million, but they will raise up to 6 million. So if more people than this 5 million subscribe, they'll take up to 6. So they're giving us two alternative sets of numbers there. This is also required. We've got to say the indicative timetable. So in other words, if I'm going to give you my money, and the money would be put in trust as an investor in this company, I'm getting an expected date for firstly when I would get the holding statement. So when I get the holding statement, that's when I know that I've got something I can trade. And so on the 19th of December, I should be able to trade.
We can actually follow this stuff.
Yeah, well, it worked. That's one of the reasons I checked it, because I thought it'll go well with our next, if it gets up. Nice little summary table at the beginning with the key issues in it. Again, tells you where to have a look in the document. I'm going to float through very quickly because I want you to have a quick look at the risk section.
The question about the Asx is to make a minimum threshold for the Asx is, can it include the actual IPO process?
Yes.
Okay. Because their Asx are way close to threshold.
Yes. So they're pre-money. So at the time in order to make a successful application, at the time you are admitted to the official list, which is clearly after the application is made and it's been approved, you have to have done all of these things. So it's at that time you have to get there. So in fact, you can make your application when you submit your prospectus to the market. Mostly you would wait on making the application until well after you had submitted with ASIC and you'd gone through the cooling off or the successive 7-day periods anyway. But most good corporate lawyers one of the first things they would do when a client came to them saying we're looking at listing is that they would initiate a meeting with the company's department at the ASX anyway, because you don't want to have any surprises. And nobody wants, really, to make an application that fails, because that impacts the way the market feels about you.
So those thresholds,
they're very low.
They're very, very low.
Yeah. So the thresholds themselves are not the barrier to entry.
No.
So again, it's but that's actually something too that the general public doesn't necessarily know, that there is seen, if a company is a listed company, it's seen to have more weight and more credibility in the market. The reality is there's no particular reason for that. A listed company is no more or less likely to fail than an unlisted company. The statistics don't really bear that out. It can be easier for a listed company that's just fallen on hard times to raise additional capital because there's a mechanism in place for them to do that. But then again, continuous disclosure means all your competitors know everything that's going on with your business. So, a little bit from column A, a little bit from column B.
So this prospectus is a requirement for the listing, getting the listed, or the rising?
Yeah. So when we looked at the rules before, one of the rules requirement is that you have to have a prospectus, or if you're not raising money, an information memorandum. In order to raise the money, you have to have a prospectus as well.
Yeah.
So there are two reasons why you need to have a prospectus. It's to do with the funding as well.
Okay.
So I just want to have a quick look at the, I'll just scoot down here, have a look at the risk factors, because, now I've scooted past them. Again, these tend to come out in a pretty standard way, but they tend to be grouped in risks that are specific to the company and risks that are specific to the industry. But you often see they're very generic. Now, and this is often where the biggest fight is in the preparation of a prospectus, is the people who are promoting, who are looking to raise the money, they don't want to tell people about risks, right? But the obligation, and we'll look at the Corporations Act obligation shortly, is effectively to tell potential investors anything that they would be reasonably required to know about the prospects of this company and the risks that it faces. And it's really interesting just how generic risk statements go, and particularly as there is so much liability hanging on this section of the prospectus. If you are reading a prospectus, this is actually the first place that I go to have a look at, firstly, that gut feel test. What do I know about this industry? What do I know about this company already? Do they see the same risks as I do? They're not talking about things that I think are risky. Then I'm thinking, they're not thinking about their business well enough, or they don't care enough about this process. If they are, then I'm probably reading it relatively carefully to think about, well, are they just being generic here, or is there some information that I can get out of it? And often, there's again a push-pull here, because the standard for prospectus disclosure is higher than the continuous disclosure requirement. So it can be that competitors are immediately looking at prospectuses to see what they can learn about their competition that might help them. And ASIC and the ACCC, for that matter, unabashedly say that they welcome calls from competitors who are going to point out things that they think are wrong with prospectuses, because competitors are really well placed to understand the industry. We have regulation that relies on dobbing. So have a look at, so often, though, other people will look at the risks and say, oh man, just look at the volume of them. There are so many risks here. Why these general risks? Why would, there's taxation risk, what would I do? But when you actually read into it, I think it can be just death by prose too, that we end up with these big generic statements without really having a better understanding of what the risk is.
The problem with prospectuses, particularly aimed at undead investors, they see this document and just go, well, I'm just going to go with the vibe of it, because I'm not going to read that.
Yeah, well, and often a financial advisor is actually ripping out the pages from the back because the law prohibits you from offering these securities for sale, so a subscription form, giving anybody a subscription form unless there's a prospectus attached. So they're either ripping them out the back and just giving them to the investor, saying, I recommend you go with this, and mumbling something about, and of course you don't have to pay me anything, but I'll get a small fee from the company for giving you this information, or from the underwriter or whoever it is, and, leaving that said. Now, well, these days financial advisors have to give much more written advice, but again, death by prose, they don't necessarily read it. Or you're looking online and you're just ticking the box, yes, I've read the prospectus, and going straight to the